Hi, and welcome to episode number 23 of Slot Leader, a Cardano finance podcast where we try to bridge the gap between the world of finance and the world of blockchain technology. I'm your host, Umed Saidov, and in today's episode, we will be focusing our attention on decentralized exchanges built on Cardano. My guest in today's in-depth interview is somebody who has a proposal for funding in fund number 5 in Catalyst to build such an exchange. In our in-depth interview, we will be going through the fundamentals of decentralized exchange. We'll be covering the questions of what the decentralized exchange is, how the participants make money in these kind of venues, what the risks and the pros and cons are if you do decide to participate in these kind of exchanges. And last but not least, we will be talking about red flags. These are basically the types of information that you would like to obtain before going into decentralized exchanges that might give you a clue as to whether these decentralized exchanges are trustworthy. We have seen a lot of rug pulls in the recent history of open blockchain, and I wanted to kind of shed some light on this issue in particular to find ways to raise the red flags for you and to make sure that you could do your due diligence looking for the right information out there. I hope you find this interview quite useful. I definitely did, and you let me know in the comment section below what you think about it. Before we go to our interview today, I would like to make a special announcement with regards to the changes in the format of Slot Leader. Going forward, starting with episode number 23, today's episode, we are going to go straight ahead into our in-depth interviews. And I think this is where the major part of the value proposition of this podcast is. And also, if there are any major news events that pertain or affect our space, the space of Cardano, I'm sure we could cover it in with my guest in the in-depth interview a little bit. So in the interest of expediency and generating maximum value for our viewers and listeners, I think this would be the right step to take. And going forward, we will be just focusing on the in-depth interviews. Now, that said, I'm going to continue doing my AMAs with you guys. I really love interacting with my listeners and viewers, so be sure to catch those whenever they come out. Hi, this is a quick reminder that Slot Leader is an educational podcast, and as such, we do not provide investment, financial, tax, or legal advice. Hi, ladies and gentlemen. I have a special guest today in our show. His name is Yarek, and he has a proposal for Fund 5 in Catalyst in Cardano to develop specifically a decentralized exchange. I would like to welcome Yarek to Slot Leader. How are you today?
Hi, Umut. Hi, everyone. Thanks for inviting for the show. Big fan. I really like the approach you take talking about the fundamentals. So, I'm glad that's the first show I'm able to join, and looking forward to interesting discussion about the DeFi.
Yes, I've exchanged a lot of messages with you on Twitter. It seems like you know what you're talking about, at least from the traditional finance point of view. And I've read your proposal on the DEX. Thank you for trying to develop something on Cardano. We are always open to getting more talent to develop on Cardano. So, introduction. Can you tell us a little bit about yourself and your team?
Sure. So I will start from myself and then I segue into the team. So I have a bit unique path to Cardano. I started basically coding as a 6-year-old kid. I joined this whole cyberpunk movement, staying on the text forums, hanging out in topics about hacking, reverse engineering, etc. So this in a sense gave me understanding of the network and the security of the systems. And then from that, I had interesting path, through Microsoft research while working on devising machine learning algorithms. Then to the world of finance, and I've transitioned from Microsoft to Citadel Securities, where I work on creating a new desk for semi-systematic trading. It was a new paradigm they were developing. And it was quite a success. And like working for a market maker is like amazing experience. Basically, everybody around you has like 5 brains and a bit more. But basically, because the knowledge is so concentrated and experience, you end up working crazy hours. And basically, at some point, I basically felt drained, like not having any time for personal projects, being constrained, like being mainly able to focus on work. So then, I transitioned to my current role where I have a bit more freedom in what I can do. After 2 years, managed to get approval from legal to double in crypto. And basically, I'm in a transition period, from my job. So, been asked, to not to be too vocal about it. So, I try to not be too easily Googleable in, that, I'm, living in 3-4 months, to not scare anyone. On the team, I manage 3 teams in my current job. And also interesting how I've learned about Cardano. So the one part I skip is the university. I went to the University of Edinburgh. And I had the pleasure taking the courses done by Phil Wadler, and he's very amazing lecturer. He has all the stunts. With the lambda on his shirt, he's very verbal. He describes everything amazingly simply. Learning functional programming was pure pleasure, but then being a student where you can also take other courses about the formal theory from him, which are much smaller, much more on point, and actually being on Haskell conference. He then introduced this idea. It was 2 years ago. They're building the Lambda calculus called Plutus, which they're going to write the formal proofs in Agda to prove actually everything is sound and working. And it's when you are in finance and you're dealing with all these exchanges, they're fixed 4.0 format to send all these exchanges, etc. It's complete mess. And then the legal side, the naked shorts, etc. This is just the tip of the iceberg. So when you think, hey, wait, we can not only make it trustless, publicly verifiable, but we can also build it from the first principles. And there is this functional programming gem I'm big fan of, written by Simon Peyton-Jones, which basically shows how to derive functional contracts, like functional derivatives, from the fundamentals. And basically, not only you derive them, so it's like in mathematics, you take derivatives, you literally do the same in the program. You also now can write a formal proof that this derivative has specific properties. Maybe, for example, that's only as many shorts as the coverage you have. You have to cover every short, 1-to-1. And basically, also it's type checked, right? It's the beauty of Haskell. It has very rich type checking language. So, it gives you a lot of power out of the gate. And, I felt in love with the idea. I couldn't get it that I was too overworked. And basically, I still didn't know if I can actually even do that. The resolution came, at the end of the last year, so that I can. But, yeah, so here I am, excited to be here. Maybe it's hard to be late, but, it is what it is. It's life.
No, I think you're still early. I mean, we don't have the smart contracts yet, on the mainnet, and this is the right time for these kind of projects to actually start getting traction in the community. And thank you for sharing your background and your, the path that you took from whatever you're doing in the traditional finance side, and getting exposed to Haskell and Plutus, and discovering Cardano and coming on board. So tell me, when you're developing this project, and it's just just a curiosity, are you going to be still working in the traditional finance? You just basically got an approval to work on side projects, or is it going to be a full-time job eventually?
So I'm in the transition process to basically Cardano to be my full-time job, but unfortunately in finance it's a long process. They wait a lot of in the agreement to keep you for the long time, but before the launch all should be sorted, and that's also when I'm going to tell everybody by name, because there's nothing technically stopping me, no surprise for the team, etc. that I'm working with.
Okay, well, this kind of, answers the next segment that I wanted to focus on, which is anonymity. So you decided to become anonymous, or to come or develop this a project anonymously for the time being, because there are restrictions on your current employer not to talk about crypto and publicly, at least be associated with crypto and be a part of a current financial institution that does
Mhm.
traditional finance. And I understand that there's some sort of hesitation in that world not to be associated with crypto, especially given the fact that there's so much fraud going on and outright rug pulls going on in in other platforms, especially in the DeFi. So I understand there are reputational sort of risk mitigation strategies that would curtail your ability to talk about this. But obviously, you are here, your face is here, and those who know how to reverse image Google search, you will find out who you are. Thanks again. Thanks again for coming. And I would like to take this time to actually delve into what you guys are doing, because it's
Mhm.
very, very fascinating. This whole concept about DeFi, I find it quite fascinating. And I would like to devote a huge segment of time going forward to basically deconstructing the components of DeFi and how it works in the real world, and what you guys are bringing into the decentralized finance, and how you will make sure that the code that runs executes as expected, and minimizes the risks. But so can you talk a little bit about your proposal and what it does? I mean, I read the proposal, but it would be great to get a 5 minute sort of description from you, a short description.
Good, sure. So the first proposal we've got is for a DEX called Maladex. We basically completely screwed marketing, like basically use all the forbidden word in the world of crypto, I guess. But it is what it is. Maybe let me start from the whole theme, why it was associated with demons, etc. Maybe like it added to the veil of anonymity, like a bit, you know, uh, suspicion. But basically, the whole idea is rebel investing. So bringing the new ideas to the DeFi space, not basically copying existing solutions from other blockchains, just writing them in EU to EXO format in Haskell, but basically sitting down, writing proper research paper, like investigating the automated market makers, investigating, like the correlation and other properties of the pools you're going to create. And then basically the same for, like minting indexes, derivatives, and, like another important topic that like once the basic DEX is done, is basically introducing the things that are constructed of the disposable. So for example, like once you have options, you can construct option structures which give you very tight control of the risk. And like usually what people know options is from Robinhood, basically losing a lot of money very quickly. That's like what the naked option basically does to you. But if you, for example, like create any form of a spread, and like it's very easy to visualize, like you can basically say, okay, like my bet is that this, like Cardano is going to go either way by 10%, right? You can buy just, like a simple, like a bulls,
Straddle.
straddle, etc. And at the same time, like if it flies crazy, whatever, like it's another fad, you are covered because the other, like strike covers your lower side. And then the cost of buying option is low. And, like this
You
can
can
give
leverage it.
exactly very tight control, plus potentially expose you to larger gains, as that's the idea of bringing new ideas for everybody to be able to profit. And that's the important concept that we have. We actually will use some of the governance tokens to pay people to write articles. So basically, by the views, like you receive some distribution, and we're going to write some articles ourselves from which we want on distribution, basically explaining those concepts. And the idea is actually to start people familiarizing with those concepts, because the only way you will always be completely safe or more safe is if you understand exactly what you're doing. And like we can say, okay, like Bluetooth Haskell is more secure. Yes, to some extent, but only more secure if the developers writing the contracts have good intentions. And like there's like this famous computing problem called like halting problem. You basically cannot predict exactly what program is going to do. You can prove it has certain properties, but I don't think people will expect everybody to start writing ACDA proofs and sharing them, and people will be verifying them. It's always like this. Like the smart contracts sometimes are there, nobody checks it. There were recently some famous rug pulls, like where there was like some well protection which was completely disabled before deploying the contract. Like so, not enough people check those things into the code. So basically, for the whole Cardano community and for any other crypto, like always the best protection is like actually to educate yourself, do your own research, and then be like skeptical. Like somebody says something, okay, let's check the code, or have somebody check the code. Like, and then you build the trust. And there are people actually in the community, like.
Yeah.
Talking about, for example, like proof of merit. That's going to be interesting metric if it ever rise.
Yeah. Look, I wanted to just kind of step back a little bit and go through the concepts that you are covering in your proposal, step by step. Have it in a bite-sized format, if you will. So you are proposing a decentralized exchange with Maladex. Is that right?
Yes, that's correct.
Okay, so how does it work? So I think some of the products that you're describing there are a liquidity provider, products. Then you have the liquidity mining, blockchain bridges. You have indexes. You have synthetic instruments and derivatives. Now let's go through these. Let's just imagine that the product has been built, Maladex, right? So what can a Cardano user do with Cardano token in that platform? Let's just go through every single thing that you describe on your proposal. Let's just do with LPs, liquidity provider products, liquidity products, right? So what is a liquidity product? Why it exists? What can the user do? Pros and cons.
Sure. So basically, liquidity providing is the process of giving your tokens. So you give typically all the tokens that are like part of the liquidity pool. So for instance, like the simplest one is like the liquidity pair. So we can, for example, give Cardano and AGX, and like once the pool already exists, there is like expected ratio of the values. And if it doesn't exist, you mean the first time you have to provide it yourself. So like usually you would want to get the right price. So it maybe like check what it's trading on the exchange for, etc. Because otherwise you would be immediately losing some money in the arbitrage. So like you provide the right ratio of the tokens, and that's the simplest pair. There are more complex ones, which is, for example, the pool of liquidity. And I'll give you an example. Like you have stable coins, right? Like all pegged, for example, to USD dollar. There is no major reason why they couldn't be provided as a pool and be paired with other groups of pools. For example, like then you have liquidity between USD and AGX, right? But it's automatically balanced in the right ratio. So, like you can provide only USD. And I think it's going to be something important for the classical financial instruments because they even cannot have too large exposure on their balance to crypto. That's also, by the way, reason like Arco have been saying Bitcoin, not because they didn't like Bitcoin, they just basically couldn't hold anymore. Like it wasn't good for them. That's what you do as the maker. Now, as a taker, you basically can come to the exchange, and now you have Cardano. You want to buy AGX, then you can purchase it. But the challenge with automated market makers is that basically the price fluctuates and doesn't have to fluctuate with the actual price because the only pressure comes from people buying and selling, and like the amount of buy orders, for instance, for AGX, doesn't have to reflect the actual price that people are willing to pay for that. So then it diverges from the actual price, and typically, like the price is derived from the order book. So people put limit orders for sell and buy, and basically the middle between, like it's the price that you see like in a terminal. So then like somebody writes an arbitrage bot that basically looks, hey, like I can actually buy it here cheaper and sell for more, and they like automatically execute it very quickly. And they make someone, of course, it's very risky because there is like a lot of arbitrage bots and only one winner. So sometimes you're left to holding a bag. And by the way, also like for arbitrage, it's great like if you can buy options because you can buy option on one exchange and option on the other. And then basically, if you are left holding back, then you only pay for the cost of the options because like there's a zero risk option, like the neutral exposure.
Okay, so let me just basically simplify to the maximum level possible to just basically give a, I understand everything you're saying, but just wanted to walk the audience through the process of participating in a protocol through the DEX, as a liquidity provider, right? So I am a holder of 50,000 ADA, and let's just pick another number for AGX. Yeah, right. I don't know, 30,000 or
Should say $250,000. It's like double the right ratio.
Okay, the 250,000. So, in order for me to become a liquidity provider, right, I need to provide these tokens in exact that ratio, right? Is that correct? Is that the requirement for me to participate in the index, or is a liquidity
Yes.
provider?
If you join as a second person, then you have to provide it in the existing ratio. But if you mint it, you can provide it in any ratio you want, but you want to provide in the exactly right ratio, because otherwise you'll be arbitraged right away and you lose the wrong balance you put in, basically.
Okay. So the moment I go in this liquidity pool, and I'm trying to basically understand the mechanics as we go through it mentally. The moment I put in, the price changes, the balance changes. Do I have to start, putting in more and taking off ADA and things like that? Do I have to be actively monitoring the balance in order to keep my position as a liquidity provider, or the contract does it in its own way?
Sure. So, by the way, it's also like the case not just for Maladex, but for every AM. It's like you just deposit the tokens, and basically they are in the contract and are basically used to like exchange one token for the other. So you basically don't have to do anything.
Okay.
So like it's completely out of your mind, except there is risk just leaving it lying there. So there is like this concept of impertinent loss, and this happens when, for example, like you were unlucky and you picked a bad coin, or like I don't know, like maybe there was some coin, somebody was giving what utility, and like there was like a lot of hype, so like you bought that coin, and like suddenly everybody lose confidence in that coin. And what happens like is everybody wants, for example, like ADA back immediately from that pool. And then there's nothing you can do. Like this pool is going to drain one way or the other. And like that's the first one. Like you should think about the pairs you are providing, or like the pools you are basically providing your tokens in, to avoid basically just being left with the worthless token. Because if everybody gets at the back, you are just left with the tokens that has zero value, like the other.
Okay. So the risk, as far as I can understand your description, is that, the two pairs that I pick are important because, let's say that, token X versus ADA, if X becomes, useless, everybody would basically use this contract in order to exchange their X token for ADA, because the exchange rate doesn't, is it fixed in that contract? Does it fluctuate as the demand grows?
It fluctuates. So basically, whenever somebody buys specific token, so like I want to spend Cardano to buy AGX, I deposit Cardano, so I increase the ratio of the Cardano in the protocol, and then I withdraw some AGX. So now, like the simplest X times Y equals cons formula, because like the number of like liquidity provided has to remain constant. Now I've increased the ratio of Cardano and decreased the ratio of AGX. So at this point, the basically when you want to provide, like next you would provide now more Cardano and more AGX, because that's basically affects the price. And also that's another important concept. Like it's good for the liquidity pair or pool to be large, because otherwise, like if the pool is small, like it's very easy to move the price very significantly. And that's another risk, because like if the pool moves too much from the actual price, like then the arbitrage bot scams and basically like really likes that pool, right? And by the way, this comes like one of the things we are currently researching, which is looking at the formula very closely. And there are different pairs of the assets. So I'll give you the most basic example. You don't ever want to have the stable compare with anything on the blockchain for a simple reason, like maybe except few special cases, because all the crypto by nature is deflationary and stable coins are inflating. So by the nature of those two instruments, they're always going to diverge. And that divergence creates impairment loss for you. You want two assets to be as closely correlated because, like we can assume AGX and Cardano are going to be quite correlated. Maybe AGX, like still has the most investment to come, so maybe it will go quicker, but like technically on average, they will be correlated. So it's much smaller impairment loss. And basically looking at a specific class of assets and being able to classify them and then adjust the curves to hold all the properties that are required. For example, path independence. Like we want to create a custom pulse just using the quantitative data, to be tailored to specific percent pools to basically, like minimize the risk for you and like improve the exchange experience for everyone because the price is right, there is less slippage and there is less drain to arbitrage.
Okay. Now, again, if we kind of close this loop in this conversation, as a liquidity provider, what is my incentive, in Maladex, for instance, to provide liquidity? What am I getting in return for locking my tokens, and how does that work?
Great question. So probably not everyone knows that, but every DEX takes a small fee out of every transaction. So let's say you exchange Cardano to AGX. Not 100% is getting given back to you. Basically, 0.3% on average is taken by the protocol and distributed to two parties. One party is the liquidity providers, and then depending on the DEX, the typical value is 0.1 or 0.2% goes to the liquidity providers, and 0.1% goes to the exchange. That's how they pay salaries and like for the service, etc. And
Okay.
those
So there's as a pie, 100% pie, X% goes to liquidity providers and Y% goes to the guys who wrote the smart contract. Is that the right way of interpreting the whole thing?
kind of. We have to expand on it a bit, but let's finish first. Like 0.2%, let's say, goes back to liquidity pool, and you own a share of the liquidity pool. So now we have a bit more tokens. So if it's like well correlated pair and there's a lot of transaction going on, then you provide a lot of utility. So actually you get a good work. So like you want to stake the pool that is very liquid. Like there's a lot of transactions going on, and the price of two tokens doesn't diverge too much. And now 0.1% can go either directly to the exchange wallet address, but it doesn't have to be that simple. You can use that 0.1% for many different things. For example, Pancake Swap uses some of that money to actually go to the exchange and buy cake tokens back and burn them. Like they send it to the void, like zero wallet address from which you cannot like recover it.
Okay.
And like you can do other things like that actually increase the value of the platform token. So that 0.1% is like in a sense in a custody of the DEX team or in the DAO. Like you could put it in the DAO, which actually is a nice idea. We're thinking about that as well.
Yeah.
And basically, some of that, of course, like have to go to people. Some has to pay for the expenses, but like depending how much you're left with, like you can do something great for the community. Like for example, like buy a lot of governance tokens back and reward everybody like equally, like for holding them. And that's the other part that you're actually getting by providing liquidity. There's this concept of yield farming. A lot of platforms are going to give you the governance tokens for basically providing liquidity. The trick is you have to be very smart about doing that because in a sense you mint the governance tokens out of the thin air, right?
Yeah.
So if you mint the token and give to people for providing liquidity, in a sense you decrease the value of all the existing tokens. So you have to either like provide enough utility to the tokens that the utility that's in the system balances the minting of the tokens, or you have some mechanism that basically also takes tokens out of the circulation. And for example, like you can require a specific amount of different tokens locked to have access to specific, like pro trading data, like maybe all statistics about the pool, etc. Or maybe like you want to use the governance tokens for voting, right? Or maybe
Hey,
like
my question to you is here's the thing. I'm sorry if I cut you off.
oh no,
but
it's fine.
It's quite important because I don't understand why there is a utility token for a DEX. Why can't they just use ADA? Like, why do you need to create another token to confuse the hell out of people? Like, like, why can't you just use ADA? There's a governance mechanism built into the protocol, and correct me if I'm wrong. You should be able to do all sorts of things with that. Should you want to use ADA as a token of governance, and then you don't have to manage anything. You know that the supply is fixed, and you need to maximize it, and maybe you could tag the ADA that you have somehow that it's kind of attached to Maladex, and it has superpowers, let's say, right? This concept of colored coins. I think they used it in tracking the New Balance shoes at some point on Cardano. So you probably could do something like that where you could tag these ADA and say, okay, well, this ADA has these properties to it. You could vote on Maladex with it, um, or completely, basically do away with this token nonsense and just say, okay, you liquidity providers or whoever participates in this DEX will get their, compensation in the tokens and ADA, cryptocurrency of the platform, and that's it. You don't have to create another layer to do things like that. So why is that we see tokens being created? Is there any other reason, for it to exist except for enriching the guys who actually created the smart contract?
So I'll be upfront. Like, of course, like the part of the whole idea of tokens is enriching the guys who make it. Like, obviously, that's why everybody and your grandma has a token. But there is a lot of more reason behind that. Like I agree with what you said. Like, we could attach the color, but if like if you want to do certain things right, like Cardano already has a ton of very heavy whales. And you could try to introduce the anti-wall mechanism Cardano, etc. But it may be quite complicated. So as long as you are a DEX that prioritize the good of the whole community, you can now start talking about things as quadratic funding, etc. But even more importantly, I think that's a case unique to us. We actually want to implement the layer 2 on Hydra Head, and that has to do with interoperability between different protocols. And then we need some pair tokens that we can basically attach to all the different protocols. And of course, this also could be ADA, but this just makes it so much more complicated, because when you think about ADA, there are so many market forces, like in ADA, that when we design a system, we want to if we to have certain properties, we don't know what properties is going to have. All other DEXs or other protocols are impacting, like what's going on with data. And this is much more complex problem to solve. But not only that, the good thing about the token that you're going to create is, you can, you very clearly can define where the value comes from. And by the way, for me, just the governance is a bullshit argument. If the token just gives you the governance, get out of the way. It's not enough, right? Or if you need 0.25 EA to trade on EA, it's nonsense, right? It's literally a Ponzi scheme, because you have to accumulate the tokens to be able to use the system. So basically, it's a grateful theory. The value of the token is derived from more people getting the token, right? So the ideal utility comes from functionality, right? And actual functionality, in the case we are thinking of, is basically to tying the token burn to specific resources going. For example, we want to create backtesting platform where you can get all the high frequency data and validate, specific assumptions about the data, a lot of tick based data from our exchange and hopefully from the others as well. And you could pay just the fair computation price in the token. Saying, basically when you create all those tokens that are derivatives, indexes, etc., we want you to pay for them in our platform token called Sol. And then it's also much easier to implement the vesting. So for example, if we are going to distribute a part of the token to the team, then we can, once the smart contract launch, we can codify that. Basically, that's the vesting schedule, and we are not shitting you because now, sorry if you that gets motivated, but it's now you basically can go into the contract, and there's like there's a lot of people being able to read the contract, and that will tell you, okay, yeah, those guys have written the contract, right? So they can only vest on the dates that they show to you, and that's true. Like you define it by the slot, and there's like a slot average every second. Um, and that's another example. Another example is when we cannot drop Cardano at least on the day one, right? So it's like the promise of the future profit. So like if you say like you want to distribute tokens to the community, and we do it at the moment via our help pool. So like everybody delegating to help pool. We only have 1% variable fee. It's not ICO, not all of that stuff. We can talk about ICOs as well. I think it's another idea that flips the Cardano protocol in its head. We are basically distributing the square function of the SOL tokens per epoch to basically people delegating the ADA to us, and basically that's the idea that we can start with the allocation that's more spread across different wallet addresses, and that's actual people in the community. And it's not linear in the sense that if you're a while, then you get like a big chunk of that. And then it's
Are you
also
doing it, by the way, right now, or you thinking about doing that?
so
Distributing your tokens.
yes, we just started doing that. So
Okay.
we started sending the airdrops. Basically, we have a small delegation to the pool, so we were waiting to accumulate the all the past epochs to because when you send tokens, you have to add ADA to it, and uh, us coming even from financial sector, we have limited resources, so we want to minimize the cost of sending the tokens. But we just about started. We had also a community event called Maladex Maze. That was 13-day game where people voted on different options, and the 13 lucky people. Actually, this one is going to disclose on Wednesday who the 30 lucky guys or lasses who are getting souls, and basically that's the way it is. And but by the way, it already there is so much to it because I agree with you that in a sense it's like asking hey, give me a money and I'm going to do something that has so much value that you are going to profit in the future. It's like in a sense investing in a stock, right? But it can be also very easily abused. And if you are not doing much development work and then you are sending airdrops for action on social media, and then you are going to list your tokens without actually building anything, and then the price drops obviously and then there is maybe 10,000 liquidity left, then yeah, basically probably the reason was the coin sell, right?
Yeah.
And I'll tell you right away, to build a deck that at least is my estimate, you need between 10 to 200k USD.
Yes. Look, I'm sorry if I'm changing the subject a little bit. I
Of
wanted
course.
to basically go through the products that you're offering so
Right.
that the viewers understand what the DEX will do. So we kind of touched upon liquidity providers, right? You put on your tokens, you put on your ADA, and you will earn interest on your tokens and ADA, which will accumulate to you based on the fees that the DEX charges. And
Yes.
the reason why DEX will function is because people would want to borrow either AGIX or ADA. Is that right? In liquidity
Yes, but not borrow, just exchange.
exchange. Okay, so it's just basically yes. So they want to come in with ADA, get AGIX, and it's not borrowing. Yeah. So the second thing is liquidity mining.
Yes.
Could you expand on the concept? What is liquidity mining? What does it involve? What does an ADA holder need to do in order to have access to liquidity mining as an instrument? What is the person getting from the DEX like Maladex from liquidity mining, and who is using the end product on the
Sure.
other side?
So basically, the liquidity mining or yield farming, comes from the idea that some less liquid pairs are much harder to create on the DEX. So what you would do is incentivize people to create those pairs by providing them with your platform token. And like I think Pancake Swap probably is the most popular one for that. But a lot of other platforms do it as well. And then you have an allocation of the token that you create or like unleash every day, like if it's pre-mined. And then it's distributed across the liquidity pools you want to incentivize. And you would want to incentivize certain pools. So for example, like there may be like interesting projects that you want people to be able to exchange, like there's going to be value in that.
Okay.
Then you would say basically, we struggle to get, like this Cardano and some other new project pair on the exchange. Let's incentivize people to create this pool to provide liquidity to this pair. And for example, let's say like every day, like you get, like specific allocation of the SOL tokens for that. And basically that's what happens. The only challenge with that, in my opinion, is by nature, like if your price of token is not appreciating on its own, this naturally decreases the price of the token. So like you have to make sure there is enough mechanisms in your platform that burn the tokens. That like for example, like if you every day means 500k tokens. Like it's not a case. Like that's what the Pancake does, but we have still quite different tokenomics. But then you have to ensure that you at least on average burn 500,000 tokens a day as well.
Okay.
That's the fair thing. You
So
don't have to do that, but that would be the fair to the holders.
okay. So this emission, is it dynamic or is it fixed? Let's say that you're developing these markets, right?
Mhm.
X token versus Cardano, and X is a big, it's a starting token, and there's not a whole lot of people know about it. Let's say that the brilliant team behind that token X would want to do stuff, but they need the market to be able to raise capital and whatnot through this exchange of yours. Now, does the system allow to fluctuate the amount of, let's say, SOL tokens that will be issued for each liquidity pool, or is it fixed? Because if it fluctuates, let's say that you start with 500,000 injection into for liquidity providers, and as the token appreciates, you could reduce that, and then the market is very mature at some point. Then you just basically say, all right, we'll use that SOL token for something else. Some other pools that are up and coming, we can use that. So how does that work? Is the mechanism dynamic, or you're just fixed, and then I mean, I don't mind, to be honest with you, like the returns for people who start successful pools that way will be exponential in a sense, because then you will get a lot of returns from the successful token that you have from SOL if it's fixed, and from EDA that you will put into that liquidity. How does that work?
So it's a very good question, but also a very hard one. So let me tell you like what we want to do. Basically, we want to specify a decaying function. So like we start with a specific fixed amount, but this amount decays over time. And basically the idea is that as the platform matures, you need to less incentivize the new tokens, and also in the same
Why can't
function.
I'm sorry, why can't you make it a basic function of price, using oracles and whatnot? If there are, I guess I understand the challenge. If there are no markets and you are the market, then it's a question. But why can't you use your own price? Let's say.
Oh, obviously, like that you have to use. Um, that's why it's challenging, right? So I said like we want to start with the decaying function, but then wanted to go down to the complexity, and the complexity is, like there are certain market conditions where basically doesn't make sense. For example, like to create the incentivization, or there are maybe market conditions in which you really want to incentivize. Plus, you always have to take into the account that this incentivization comes like it's a stock dilution equivalent, right? Like it comes out of the pocket of the existing shareholders. So if you do that, this technically should lead to like long-term increased value, right? So like So what I want to say is, ideally, you would define a model that works and locksmith is very predictable. And the advantage of that is that people can then understand what impact on the price is going to be, and this impact is going to be smooth. The disadvantage is market is very hectic space, and then the black swans like to fly into your face. And black swan is something basically very unexpected event, and like you want to have some control over that. But I believe like this can be solved other way. So like as I mentioned, like the exchange, for example, like takes 0.1% of the profits, and this goes to the treasury. Like we want to maintain the treasury that can be used in the strategic ways, like to basically, like, hey, like those tokens may not be being minted, for instance, they may be coming directly from the treasury. So you don't increase the circulation in a sense, like you as a platform pay for the liquidity directly. Or you, for example, like the, I don't know, for whatever reason, the token price drops and you want, like people to go back to your platform. You go on the exchange, buy the tokens back, the price rises, and then people have incentivized to go back, right? You can do a lot of strategic things, and basically, in my opinion, like the when you mint new tokens, this should be absolutely predictable, because otherwise it's not fair. But if you need to control the unexpected in the market, then you should be very responsible with your platform gains and basically maintain a healthy treasury to be able like to create those incentives, etc.
Okay. All right. Let's talk about briefly about bridges, indexes, and you call it differently, but I call it synthetic instruments. I think you call it something else in your paper,
I
but I
call it
think
synthetic mirrored instruments.
yeah. So bridges quickly. What are they? Why they need to exist? And how do you want to implement them?
Right. So the classical way, actually, let me maybe say before what a bridge is. A bridge is for you to be able to interact with other blockchain. And the classical way it's done, you wrap the tokens from the other platform. So basically on the other platform, you either have to burn the token or you have to lock in the contract. And then basically you release the wrapped version on Cardano. And for example, in this way, Cardano investors have access to much wider like span of instruments. And like if, for example, like we want to create an index, right? It would be a bit of a shame if we cannot include Bitcoin, Ethereum, Solana, and all other projects on that. And I know, like we all love Cardano, obviously. But like if we want to make a healthy index, this should have like a right profile. You can like either weight it by market cap, you can weight it by different ways. You can have like an index of all like Cardano dexes or DeFi index, but you can have even like the DeFi index for different blockchains, and this is very interesting concept. And basically, in a sense, this creates an access to people using the platform to much wider range of instruments, and we think it's great. But the way we want to do it, ideally, it's dynamic. So like we don't require like there to be wrapped tokens in advance.
Yeah, that was my question, because why do you need? You could create an index with basically oracles, right? You just
Synthetics.
need the price.
Yes.
That's it. And then you can
Uh,
create something that represents Bitcoin, let's say, whatever, like, and
uh, it's basically being wishful, because classically there are two ways to create synthetics, and one is like you back it with a physical asset, and the other one is you create collateral. With the physical asset, like you guarantee that's what it is, because the actual stuff is behind it, unless like you are lying, but hopefully we can catch it in the contracts. And with the collateral, the problem is when the market is smooth and everything goes well, then like you can balance the collateral, you are not liquidated, etc. But now imagine one of those nasty birds, black swans, flies your way, and then your contracts are liquidated. So like it's terrible experience for the contract makers who created those instruments. They lose a lot of collateral, because as the market diverge, you have to basically incentivize people either to liquidate the contracts or to buy at premium the actual stuff that you like the contracts you send out, like to reduce the risk. So that has negative effect on the contract makers. And of course, there are pros and cons. The big pro is like it's extremely easy to make, right? Like okay, just take ADA or some stablecoin, whatever, in the rate ratio, and the ratio is usually like 150%. So like you're in a sense over collateralizing, but that's to cover those price fluctuation, because usually like when the collateral will go to 100%, then you want to liquidate right away. So it's also cheaper, right? So like when you want to mint the token, it has cheaper price to mint it. And if that would be an actual bridge, for example, like via Hydra Head, you could quite literally say, okay, I want to, like provide those Bitcoins, and I want, like now to wrap them, like as, like some form of derivative, etc. Maybe, like an option. Then you can do it quite directly. Like it's like you basically in a contract you can specify that happens. Of course, it's more complex because like it has to be integrated with the other protocol, right? That's why the Hydra heads are so interesting concept. But I think we are so early into the idea of the Hydra heads and like that overall, that's going to take a long time to mature and actually understand what's going on. The big advantage of Cardano layer 2 is that's exactly it's homomorphic, so it works exactly the same way on layer 2 as the layer 2. Like they basically the same thing, except one is layer 2, right?
Yeah.
So you use like Haskell, use Bluetooth, like it integrates very nicely. But we have to see. And by the way, in the time being, like there are teams building wrapping protocols. Like we can create the first version of the bridge with those wrap tokens. That's like not technically a bridge, right? But that provides that utility.
Oh, let me go deeper on the issue of the bridges, right? So let's assume that you created these bridges. Who is the owner of those bridges, in the sense that who controls those bridges? Let's say this wrapped Bitcoin, it exists somewhere. Does it exist on somebody's server, or is it in a smart contract? How sure you are that that's wrapped Bitcoin is actually exists and is equal to one Bitcoin?
That's
How
the
does that
trick.
work?
So the only way it would actually work if it's a decentralized protocol.
Okay.
So it has to be a smart contract, and it has to be like fully executed by the user action. So you say, okay, I have this Bitcoin here, I want to wrap it, and then you provide all the necessary data. So like there's like the part of the other blockchain that has to function as well. It's like very interesting as how it would work. But as we know, like IOG is creating, like the KVM, etc. Like there's some idea of the interoperability between protocols, and then basically it has to be like the centralized protocol. Like we provide the code that gives you the endpoint to perform this function, and then Hydra is most likely the settlement layer, where exactly like it's going to be the glue between the other blockchains and Cardano blockchain. And like but like no, if there would be any custody required, then basically we're not doing that. We don't want to deal with a custody of the user funds. It's too risky, and like that's not the idea of the decentralization.
Okay, so this brings me to my question.
Mhm.
Are you familiar with the concept of NepoPow or NepoPos?
Oh yeah, you
So
mean
do you
Ergo, etc.
yes? So do you think that the blockchains on the other end would have to implement this concept? And as far as I understand, these are small proofs that something exists in another protocol that you could pull from another blockchain, and then allows you to lock, let's say, the Bitcoin in the Bitcoin blockchain, and then create the equivalent amount of, let's say, Bitcoin or Ethereum, on issue those tokens automatically. It's kind of a cross settlement thing going on in Cardano. Does the bridges that you describe, do they require the successful implementation of NepoPows and NepoPos?
So like it's ideally you would have that, right? Like that's the ideal outcome. But I can tell you right away, like this is Tower of Babel, and this is even going to be bigger Tower of Babel. So like by the way, shout out to all the Ergo eggheads. Like it's amazing project. I'm a big fan. Um, so that's the ideal outcome. But if the ideal outcome doesn't come, right, and this is something that's valuable to integrate with, then you have to actually find a way to provide the next option.
And what is that?
Probably, like contracts on the other blockchain that let you lock the tokens, and they can only be unlocked when the proof from the other blockchain is created that verifies that, like now those tokens can be unlocked.
So that requires a settlement, some sort of an intermediary step,
Yes.
right? That will inject data into those contracts, and who will be providing that information, and is that network of whatever I'm thinking oracles trustworthy?
That's a good question. So, by the way, we didn't think about it in enough detail, so I don't have answer for you. I can only tell you what I was thinking in terms of the solution. So, basically, like every blockchain has a different heartbeat. So, for example, like Ethereum creates a block every 8 seconds, Cardano every second, and so on. So you and by the way, creating a block is also not like finality.
Yes.
You may get the wrong information, so sometimes you want to wait a specific number of transactions. So you could create like a protocol that first requires you, for example, like to log in with your MetaMask and say, okay, now I'm depositing those tokens to be wrapped. They are wrapped on another blockchain, and then you wait specific number of blocks, and then as you said, like this could be Oracle. But the problem for oracles is the delay, right? So you get the information on the Cardano blockchain like every second, and like it creates like this opportunity that like probabilistically you can try to create the token on Cardano blockchain and to stake on that one. So there has to be like, for example, like some period of locking in which you cannot unstake. It can be written in contract. It's nothing special. And this gives you like the security, like that you have enough time to verify the tokens are there. And then like once you confirm them, basically you can create the tokens on the Cardano blockchain.
Oh, I see what you mean. So you could do it as somebody who is controlling a wallet, interacting with the smart contract. Is that right?
Yes, you would have to be owner of the contract, but you wouldn't be necessarily the owner of the funds. It's like literally a condition that has to be met for the funds to be unlocked. But it's not deposited into like the protocol wallet, like it's in the contract.
Okay,
Your
cool.
wallet address.
Cool. Now, let's talk about synthetic instruments and why they exist, and what kind of role do they play in the traditional finance, and what are you trying to bring into the DeFi, into the Maladex. By the way, I absolutely love your value proposition, which as a traditional finance person who's gone into crypto, very much appreciates it. So the whole concept about market efficiencies, right? I time and again, and it has to do something with the fact that crypto is a nascent sort of sector. That we don't have ability to have efficient pricing, and my understanding is that synthetic instruments and derivatives will make that possible. And one of the things that we have as stake pool operators is that, for instance, if I am legally liable for taxes, right, in the United States, 25% or 30%, whatever, depending on person's jurisdiction, you're creating tax liabilities every time your pool receives, ADA. And sometimes you don't want to take that risk. And wouldn't that be great if I could sell my, my ADA tokens into the future, with the series of future contracts, lock in that rate and forget about it. Like 25% of my, basically tokens automatically gets, it's sold at a certain price, but, I will deliver them throughout the year. Something like that would have definitely helped stabilize the prices and make markets more efficient. So without further, getting too much into detail, but can something like that exist on Maladex? And is synthetic options, if synthetic instruments and derivatives going to help us?
Yes, by the way, I love the example you have given, because like sometimes you have the tax obligation in the future, so you want to guarantee like you can, for example, like sell a specific price, but without actually selling. So you want to have the option to sell at that price. So you could basically purchase a futures contract from somebody who has, like the belief actually it's better to sell the futures contract than, than to hold ADA. And basically you get the option to buy this amount, to sell this amount of ADA for this specifically agreed price. And this what creates like the continuity in the markets. So for example, like it's very popular traditional finance, for example, like airlines would buy the futures for like air fuel.
Yeah.
And like think about that, it's not just limited to the tax obligation or the things you want to create, like the guarantee for yourself to remove all the risks. But like it also, like when we as Cardano pull more external wallet onto the blockchain, it creates the instrument for people basically to continue doing the same things that they are used to. So we could have hopefully in the future, like airline buying air fuel on the Cardano blockchain, like the rest of the futures. How great will it be?
Exactly.
So to your first question, what synthetics are? Synthetics basically are instruments that mirror actual instrument.
Yeah.
It's not the actual instrument, it's something that mirrors that. And as we mentioned before, you can create it via collateral, or you can provide it one-on-one with basically the things that provides the guarantee that it can be executed. So for example, somebody could provide that like a USD that you want to sell your Cardano for, and could be locked into that future contract, so the people cannot use it, but in a sense they get a nice, like some percentage that the future contract is worth either way. And with synthetics, you basically can create an instrument in a sense you want. So for example, we could mirror, I don't know, like Tesla is not a good example at the board. So maybe, like we could create like Games Workshop stock whenever they got one on the blockchain. Basically, like we can mirror the price via the oracles. Oracle provide the price. Hopefully it's a hierarchy of oracles. And like there are many great oracles coming, like from Wolfram, from Ergo. I'm very excited about that. And like that's what provides the information if the contract is properly collateralized. But also then you have the synthetic asset that you can trade. Not only that, you can now start doing different things. Maybe you can create like an inverse asset. So like when you buy actually you bet in the opposite direction. And more complex stuff, you also can create futures or options. And like all of those have the specific risk models. So for the options, you have the Black-Scholes formula.
Yeah.
And then basically you derive all the principles. By the way, I have to say what I love about Black-Scholes in Cardano. You have the interest rate built into the protocol, 5.5%. How great is that? Like it makes the computation not only easier for those options, like that's it's in a sense like you have the internal clock in the financial system. So like it's not like you have to bet what the parameter is going to be next year. So it's literally predefined.
Yeah, I mean, like I want to challenge you on that one because here we can nerd out on this one. I love options. I love Black-Scholes. I've looked at it very, as a part of the CFA Society and CFA charter holder. I've studied that in depth. So here's the thing. I agree with you. You're gonna have an interest, what we call risk-free interest, where in a system as the emission rate, but the emission rate in Cardano isn't 5.5. It's a decaying function. I'm sure you know that, right? But then again, you don't know the actual emission rate because the principle or the amount of ADA in the pot that is left, it gets filled every time there is a unstaked amount of ADA. And there is I mean, back in, I don't know, 2-3 months, there was a lot of unstaked ADA. So there was this inflow of capital back to the pot that would make that rate a little bit uncertain. But that being said, you could basically you could jot down the ceiling. Let's just put it that way. You can just say that if everything was staked, this would be the decay rate, and you could take that as a rate, and everything else is going to be that kind of gravy. How are you going to implement that? Yeah.
By the way, it is a great point. I'm glad that you brought in. Yes, it's variable, but then you can also parameterize that variability. So you have a good, like the mass distribution, like where the percentage is going to be, and you can model around that. Like you can always, for example, like assume, like a two sigma scenario, something like that.
Okay. Yeah, I mean, it's a function of unstaked or not claimed stake or whatnot. I think we are standing at what was it 71% staked at this point, right? Or
Something like
something like
that,
that,
yes.
right? I mean, this protocol basically encourages staking and makes it so easy that, you have to be well, pardon my French, but complete idiot not to stake.
Yes,
Yes,
absolutely.
it's like, free money, right? And yeah, so you could a complete idiot or regulated entity.
or you could be a complete idiot to stake on Ethereum.
Oh yeah. Yeah, so that's an interesting thing. But anyway, in the interest of time, I wanted to go through the technicalities, right? So
Sure.
so are you going to use Haskell to develop this platform?
Absolutely, as much as possible.
Okay.
Even for like the backend you want to use Yesod, etc. So I'm a big Haskell nerd, and I want to use it everywhere where possible. It's not possible everywhere. Like maybe like for the front end you want to stick with TypeScript and React.js. But like Haskell is love, so why not to get some more love in your life, right?
Perfect. And smart contracts will be on Plutus. Is that right?
Obviously, yes.
Okay, perfect. And you talked about hedge fund, and we can talk about that next time. I think it's another fascinating topic that I would like to just go deep in. Um, Next topic, if you're okay with this part being over, I guess the products and whatnot, I
Can
would like to
I
talk. Yeah, go ahead.
can I just like give a small snippet of the other thing that we'll be building in the future?
Okay, go ahead.
And by the way, if you would like to have me back in the future, like with this more to talk about that project, I would absolutely love it.
Yep, I will.
So thank you. So there is another idea that once basically the dexes are built, not only ours, but like Liquid is building great stuff, Indigo is building great stuff. I'm a big fan of what MinSwap is doing, for instance. There's ErgoDex, etc. Like there's going to be a need for an intelligent, in quotes, investment vehicle. You can think of it like an yield aggregator, but we think of it more like as managing portfolio. And I think there is like a lot of unfortunate use of words because of that. Because I think people in like the centralized community don't like this word like hedge funds, etc. But basically, that's what hedge fund does. Like they provide the better return on your portfolio at hopefully the same level of risk. Like that's computed as the Sharpe ratio, and then you have a better Sharpe ratio. So basically, the name, like in decentralized world, is basically, like a yield aggregator in a sense, right? So we have the project called ex cogito, which basically means in Latin to imagine to device, and we want to use Singularity Net for some of these algorithms. And actually, we have another proposal on Catalyst for one such idea, which is a symbol of top traders following top traders. But basically, that's like the next step after Maladex that we want to put more weight on.
Okay, perfect. Now, Yarek, if I can go ahead and talk to you about the security of DEXs,
Sure.
rug pulls, and ways you could help our viewers to identify the obvious ones and maybe not so obvious ones from your vantage point. Since you've looked at this from a technical point of view, is there anything that you would like to share with us about these contracts? And right, the most famous one gained traction on the Twitter is the one that where what's his name? This one of the billionaires basically got burned for 10 million.
Mark One with Titan.
Yes, the Titan, right? So how did it take place? How do you make sure that you identify them? And what are the risks there? Even if the contract is solidly written, you touched upon it earlier in our discussion, but I'd like to know basically how to avoid rug pulls, how to minimize your risk, or how to just basically vet the viability of products that they propose. Sometimes I think the developers develop these smart contracts with good intentions in mind, but the choice of pairs basically makes or breaks these instruments, as you alluded to earlier, and that shouldn't be construed as a malintent. But anyway, so can you tell us a little bit about that?
Yep, that's a great topic and actually very close to my heart. And by the way, I just want to first say like there are three categories that basically in which you can very easily lose money. And the first one is actually, as you said, like sometimes it's not malintent. It's basically bad implementation either of in code or bad implementation of the actual, like formulation of the protocol. So actually, that was the case in Titan. They had it bugged by USD, and I think that also called Iron, and it rise in price too much. So basically, it was very beneficial to sell it. And when you were selling it, in a sense, they were increasing, I think, like the ratio of iron you were getting, which was like stable in price. So everybody rushed and sold very quick, and they just crashed the price. So this is more like the protocol design error. It's called like quantitative mistake. The other one is that obvious rug pull. You would have a project that goes and market a lot on social media. They bring a lot of ambassadors. They make public a lot of different partnerships. That's the typical path. It doesn't have. It's not like the textbook you should follow, but that's usually how it goes. That you ask like, are you building anything? Or don't ask us that question. We are too busy, etc. They don't want to talk to you. They only have the Telegram group on which they post. And then like actually people are hype about the project, and the risk is like you say, oh, okay, this is suspicious, but I don't want to lose that. So you still ape into that, and then they obviously pull the rug. And the third one is actually the hardest to spot. And that's why I want to say that there's only one protection with rug pulls, which is to be vigilant and, like always do your research, go on the forums, have very strong community that goes around, talks about that, like validates that. You don't have to be, like very aggressive. Sometimes like it's a team that made a mistake, you can provide the feedback to them as well. But then community have to know as well that this stuff has to be fixed. But basically, the gray area is when something goes on for a long time. There are like some kind of red flags. You don't know what they mean. They actually seem to be building something. They're getting some recognized names, right? And it continues and continues. But then, and for example, like they promise something, and there's like this Coffee Zilla has a great YouTube videos about that. The celebrities will get that, for example, like Ethereum Max, right? Kardashians were promoting that. What was the name of the boxer? Anyway, like
Mayweather.
yes, exactly.
Yeah.
If famous people were promoting it, and you say, oh no, obviously they cannot be promoting a scam, right? No, yes, they can, and sometimes they even will do it on purpose. Please don't sue me. Uh, but basically, that's how it works. So don't try take a word of people, and that's actually why I say like the identity of the team shouldn't matter, because at the end of the day, if it's something valuable that's decentralized, the contract is on the blockchain, you should go and basically inspect it. And of course, not everybody is able to do it, but there is enough people in the community who are able to do it, and there should be like they should have a loudest voice in a sense. Like they should be like this agora where you can say, hey, you promise maybe like some anti-whale protection, and it's supposed to be a whole day, but it's actually a minute. What does it mean, right?
Do you know what I would like though?
Mhm.
I'm sorry if I cut you, but
Oh, it's fine.
it's
I
great.
tend to prolong.
You actually describe all these three different ways of doing it, and as you were talking, I thought it'd be great to actually have a guideline for everybody out there to check the boxes. Like is the team anonymous? Actually the anonymous team on my side is a big no, because I'll tell you why. Because it's a red flag, as from the get-go, because you don't know the person. They could do a lot of damage and you wouldn't know. And not everybody checks the code, right? There's this notion that open blockchain, everybody checks the code, but not everybody does that. And we know that with DAO hacks and all that taking place on Ethereum, there's some of the code is even audited, right?
Oh, we should touch on that in a moment. Yes.
Yeah. So I mean, it's not a good defense, but if you show your face, if you show your name, then you basically become, visible, and people know where you live, so to say, and authorities will come and get you, if you do something bad. And then the big question there is, to basically prove that you actually had the malintent, and there are ways of doing that. If you siphon all the money out, and then you start basically splitting it in different chunks and then trying to push it on exchanges, that is a clear indication that you had a rug pull and you actually wanted to scam people. But if the smart contract breaks and you did not know it, and you did everything in your power to make sure and minimize that, including writing it in Plutus, then you have a plausible deniability there, and you're building a product that will make you money in ways that you didn't have to scam people out of their living. So there are ways of doing that. But anyway, this is the thing. Yeah.
I want to say one thing. Because the rug pull doesn't have to happen through the code. Like, for example, can be pre-mine that the team promised not to sell, and it's like dumping on everyone and saying, "Oh no, it's going to go back up." It's like something else.
Yeah, but that's a structural, structural thing that you can spot early on. Like, yeah, exactly, right. So
I tell you one thing.
Yarek, you can say, hey, what's the distribution like? If the distribution says, if the token says, oh, we're gonna keep 95% of the, that's a big red flag.
Obvious one, yes.
Yeah. So you can, yeah. So those guidelines would be very useful to actually develop, so that we could, at least get the, make sure that all the projects that come online asking for Catalyst funding, go through those and answer the questions properly.
I personally think you could do that, but not in a form of a questionnaire, but more actually in the form of questionnaire and in the form of an interview. What I would love to happen on Cardano is, and by the way, you and probably some other influencers in the community already started doing that. But like to have like an equal voice platform, for example, like for all projects proposing on Catalyst, and like have the same format, like maybe like 5-10 minutes, and have like VC style interview. It's not like like we have kind of like very friendly conversation sense. Like if you would want, like you can go like other way, but like we have like conversation, like comfortable conversation. The idea is like jab, like in the boxing ring.
Yeah.
Like an elevator pitch. Okay, like why you do need token, why you need that, like tough questions.
Yeah.
And if the team floats, okay, they probably are all right. You don't know, but now you are more sure, right? And then you can feel for information, maybe like, like who's your team? Did you IDO? Did you do that? Like where you getting your funds? Basically stuff that's important, like also from the investor side. It's also as important, like from the retail investors that, like the committee members are. And, like there's actually the DAO of Mountain project that does it. I would love to have this kind of Excel for Cardano. And I would also love, like to have like this equal access interview where every team has the same amount of time. Every team is squeezed hard. And if they come out of the boxing creek, like alive, they probably are a good team. They have a good idea about what they're doing. But I also wanted to add one thing about the certification, like basically auditing the protocols. So like 100% rug pulls had 2 or 3 certificates on their website. And basically the certifying companies aren't per se helping rug pulls, like they're helping indirectly because they actually go and validate the protocol. They write all the problems that are in the code, etc. But the rug pull can basically come from completely different direction, for example, like pre-mine. And this is not something that security companies say, okay, but everything works, right? Or there's things that we spot are low risk, right? It's not like, like somebody can withdraw the funds from the contract, but somebody already has, like that token or anything.
I think in this respect, people with experience in the financial sector doing due diligence could add enormous value, because we can ask questions that are outside the realm of technicalities where, you could be perfect, right? As you said, but if the guys have a 90% of pre-mine, that's kind of like,
exactly
red mine right there. Oh, I mean, red flag right there. So anyway, Yarek, it was great having you on the show. I really appreciate your insight and the knowledge that you shared with us today. It was quite beneficial, I'm sure, for the audience. I would like to have you on again to discuss the hedge funds. I think this idea is very close to my heart. And when I was getting into crypto, I wanted to create something like that. Where you have a hedge fund that manages a crypto portfolio automatically on a smart contract. And I think if when the Plutus comes comes to Cardano, I would like to pursue that idea one way or another. Basically be part of something that revolutionary in that respect. And if when we have tokens like tokenized version of our shares of Apple and Tesla and whatnot around the world, you could basically say that these hedge funds could revolutionize the whole entire financial ecosystem and make it accessible for everybody in the world. But yes, thank you so much for coming on the show again. And if you have any last words for the audience, this is the time.
So I have two last words. So I really like one thing you said, which is make available for everyone. Like that's the biggest sorrow of the modern times, because like you have this quantifying and then inflation. A lot of people aren't incentivized to save, but actually like savings builds much more stable and enjoyable life. So like if we can democratize access to these financial investment instruments that are sound, audited, and actually work, I think that would be absolutely amazing. So I'm really looking forward to the DeFi revolution that Cardano is going to bring. And to you and the whole audience, I have words. Stay awesome.
This marks the end of our episode today. If you like the type of content that we're putting together, please don't forget to subscribe, like, or comment. And when you do subscribe, don't forget to push that bell button so you get notified the next time we release an episode. And I promise you, as the time goes by, they will get quite interesting. We are entering an era in Cardano where we will see a more robust types of products and very interesting use cases for this project. I'm your host, Umed Saidov, and you've been watching and listening to Slot Leader. I'll see you next time.